The Share Pickers Podcast with Justin Waite.
Hi there. The markets are difficult at the moment. Very difficult. They've been difficult for 2 years. I mean, looking at AIM in the UK, it's been 630 days since the high. Emotionally very hard. And sometimes what helps me is to go back and read some investment books I've previously read. Because these are written by, great investors, people who've put a lot of time and thought into investing. So I'm going to cover a series of books, which, are worth probably, getting yourself, looking up and reading through. And it'll give you some sort of confidence going forward of having a system, a strategy in some way. The first one is the classic. It's The Intelligent Investor by Benjamin Graham. And it's widely regarded as one of the most influential investment books ever written, even though it was published in 1949. And the book sort of emphasizes the principles of value investing, risk management, and psychological discipline, and has served as a foundational text for many successful investors, including Warren Buffett. So here's a key summary of the 7 ideas covered in the book. Number 1, value investing. Graham emphasizes the concept of value investing, which involves buying stocks or other securities that are priced below their intrinsic value. He advises investors focus on the underlying value of the actual company, remembering that all these stock prices, this company is below them, real businesses, and rather than focus on the short-term market fluctuations of the share price. Number 2, margin of safety. He talks about this a lot. He introduces the concept of a margin of safety, which suggests that investors should buy stocks at a significant discount to their intrinsic value. So you see, the market capitalization, so that now it's a lot harder. But he was looking at companies that are valued below that for some reason. And he said this provides a cushion against unforeseen risks and enhances the likelihood of profitable investments. Using a screener would be good for that. Number 3, this is quite famous. Mr. Market. This day and age would be pretty called sexist or something. But Mrs. Market, or he, she market, him, them, her, them market, whatever it is. He used to call it Mr. Market, right? It's a metaphor, Mr. Market, to represent the irrational behavior of the stock market. And he encourages investors to take advantage of market fluctuations rather than be influenced by them. By maintaining a rational and disciplined approach, investors can make informed decisions without succumbing to market emotions. And he said one day the market would, come to you and offer you a stock at a ridiculously overpriced value. And just ignore it. Mr. Market's been irrational. And some days he'd offer you a stock, same stock, which is half price of what he offered you last time. That's what he says, the irrational market. It's not rational. It does, it's based on herd mentality. It can sway from overbought to oversold. Defensive investing, at point 4. Graham emphasizes the importance of defensive investing, which involves minimizing the potential downside risk. He advises diversifying investments across different asset classes and companies, focusing on financially stable companies and using conservative investment strategies. And in this day and age, everyone wants to earn the most possible. Where there's more reward, though, there's more risk. Small startup companies that are looking like they can return you several 100%. There's high risk in that. There's less likelihood they will achieve that. There's more chance of you achieving, a reduced reward in a mature company than there is in a higher reward in a risky microcap company. So it's got to be a good balance, between those. Number 5, fundamental analysis. The book emphasizes the significance of fundamental analysis, which involves evaluating a company's financial statements, earnings potential, competitive position, and management quality. Graham provided a practical guidance on how to assess these factors to make informed investment decisions. Number 6, it talks about market fluctuations. And Graham advises investors to view market fluctuations as opportunities rather than threats. And that's more easily said than done, especially in today's bear market, which we've been in now for almost 2 years. But, I suppose it's realising we will come out of it. When? I don't know, but 2 years is quite more than an average long time for a bear market to happen. Normally it is 1 to 2 years. So we're getting towards the outer end of that now. So the likelihood is we're not far off coming out of a bear market. And so, he sees these kind of things as opportunities. He suggests that investors should adopt a long-term perspective and be patient in waiting for the right investment opportunities by being contrarian and buying when others are selling. Investors can take advantage of mispriced securities. And in fact, to make really good money, in the stock market, it is to buy in a bear market. That is when stocks are underpriced. And they will revert to mean. It's having that patience to stick in there sometimes, but not overdoing it, overexposing. So I'm going to be rich tomorrow, because you overexpose and you get too emotionally attached to a stock. And then whenever there's another sell-off, you start to panic and sell yourself. So exposure is very important as well. And point 7, it talks about investor behaviour. Very important there. It delves into psychology of investing and highlights the importance of emotional discipline and avoiding speculative behaviours. He encourages investors to focus on the long-term outlook, resist the temptations of market timing, and approach investing with a rational mindset. That's also a lot harder said than done. I mean, I go through periods where I'm okay with the sell-off, the bear market, then other times, right, that's it, I'm getting all out, I'm going to cash. So it's that almost, opposing that behaviour, that extreme behaviour, seeing that if you look back at stock market history, the market's always gone up over time. There have been dips, where it's gone down for a year, down for 2 years. In fact, the great financial crash, 2 and a bit years. And this one at the moment, again, brutal. Nearly 2 years. Anyway, that's The Intelligent Investor by Benjamin Graham. I read it quite a few years ago, and it can be a bit dry in places, but there's some nuggets in there that are brilliant and worth reading. Like I said, used by many investors, including Warren Buffett himself.
The Share Pickers Podcast with Justin Waite.